Hello, welcome to the channel. My name is Jermaine Williams, and I run a life insurance agency where I teach life insurance agents how to build a successful career for themselves. So if you're looking to get into the life insurance industry, or maybe you're already in the industry and you're looking for a new home, maybe you want better mentorship, better training, things like that, there'll be a link in the description box below. Click it, and we'll set up a time to meet. So today we're going over a strategy that I'm really excited about sharing with you, and it's a way to increase your retirement income. Because typically most people have money sitting in a 401k plan, because a 401k plan is a retirement that's given by your job, whether it be 401k, 403b, IRA, but let's just use 401k to keep it simple. So the way a 401k works is you get your paycheck, the money goes right from your paycheck right into the 401k. It's tax deferred, so no taxes are removed. Then it starts to accumulate over the years, and then once it's time to retire and take the money out, then you pay income tax on that money. Okay, so pretty straightforward. So how does adding life insurance to the mix, to the equation, make a significant difference in your retirement years? So that's what I'm gonna go over today, and I'm gonna share a visual with you so you can see step by step how maybe that may be something you wanna look into if you currently have a 401k plan. Okay, so in this example, we're gonna assume you are a 65-year-old and you saved up $1 million inside of your retirement account, your 401k plan. So now it's time to retire and start taking distributions from that 401k plan. So we're gonna take a hypothetical S&P 500 return, right, over a 20-year period of time. So in this example, you're gonna take an annual withdrawal of $70,000. So let's say you need to live off of $70,000 a year. So you take $70,000 out. Your $1 million has dropped by $70,000. It's pretty straightforward. And that's the $930,000 here. Now, in this example, you got a negative 14.66 rate of return based on the S&P that year, right? And this is going to show you the power of sequence of returns and how it can make a huge impact on the amount of income you're able to take out in retirement. So your balance now has dropped to $793,000. So you start off with $1 million, you pulled out $70,000. That lowered it to $930,000. You got your return for the year, and now you're at $793,662. Pretty straightforward. Now, the next year, because we're going to assume a 1% inflation, right? We already know inflation may be more than 1%. We're going to assume a 1% inflation, so you need to increase your withdrawal by $700. So now, that $793 minus the $7,700, now your new base is $722,000 some change. Market did 26% negative that year, which dropped your balance down to $531,594, right? So you repeat this cycle. So we're not going to go year by year, but you can see the increases annually based on that 1% inflation. So you're going to have to keep up with the cost of living. So you have to take out more and more every single year. You can see your balance dropping and increasing based on the returns and the withdrawals. And you can see the returns in the market. So the next year, the market was up 37%. So it brought your $531,000 to $631,000. So you will have ups and you will have downs. This is how the market works. So over time, this 20-year period of time from age 65 down to age 85, your new balance at age 85 is $444,000, okay? So you start off with $1 million. As you start taking withdrawals, you get the gains and the negatives of the market, whatever it may be that particular year. But now, based on this historical return of this S&P 20-year period, your balance would be $444,000. Pretty straightforward. So that's what it looks like for most people in retirement when they start taking money out. And again, past performance is not indicative of future gains. So the S&P is not going to do this exact number over a 20-year period of time, but this is just one example, okay? So now I want to show you the strategy of what it looks like if you were to incorporate life insurance to the equation and have it work hand in hand with your 401k plan. So as we see, there's you at the 65-year-old. You have that same $1 million balance. You took out $70,000 year one, drop it down to $930,000. Market did negative 14 year one, balance $793,662. Pretty straightforward. Okay, so here's what strategy looks like. So on the right, you can see there's a life insurance policy now. This is a cash value life insurance policy, and your cash value in year one is $233,000. So what the strategy is telling you is that any year you take a withdrawal and that year is negative, what you want to do is not take a withdrawal the following year. The reason you don't want to take a withdrawal the following year is because the last thing you want to do is take a withdrawal from an account just had a negative return that year. So here, obviously you can see it was negative 14. So we black this out because we're not going to take a withdrawal that year. We're going to make a move over to our life insurance policy and we're going to take out $50,000. So why are we taking out $50,000 instead of $70,000? So we're going to assume a 28% tax bracket. So because when you take money out of a life insurance policy, you can take the money out as a loan. And with a loan, you're not charged tax. So that $50,000 is actually going into your bank account, is going into your hands. So with the $70,000, you got to account for the taxes to be taken out. And then whatever left over, that net amount is what you can use to live off of. So we don't have to worry about the taxes. So we can take out a smaller amount and still net about the same amount of money. So we're going to take out $50,000 from the life insurance policy, right? And then we look at the next year. The next year was also negative. So we know our philosophy is if there's a negative year in the market, we're not going to take a withdrawal. We're going to give our account a chance to rebound, and we're going to take the withdrawal from the actual life insurance policy. Or when I say withdrawal, I mean the policy loan from the life insurance policy. So we're going to take out another $50,000. Okay, so now the next year, the market was up 37%. So you can see your $583,000 received that rate of return and grew to $800,000. That's why we don't want to take a withdrawal when the market is down. So since we're taking a withdrawal now from the 401k or the IRA, we don't take a withdrawal from our life insurance policy. So we do that over a period of time, and you can see we had a negative year here at -7. So we took 50,000. The market did 6, gave it a chance to rebound. So you can see how the strategy is working. So the market historically is up more than is down. So in this scenario, this 20-year period, the market was down 1, 2, 3, 4, 5 times. So there were only 5 times where we had to move over and take money out of our cash value life insurance policy. So which is these 5 years. So what did that do to our account value in our 401k? It gave it a chance to rebound from those negative years. So in the previous example, you saw it was $444,000, but just by not drawing down in these 5 years, it's only 5 years that were negative, because we did not withdraw in those negative 5 years, our new balance is now $3.5 million. So $444,000 from the traditional way of taking money out to $3.5 million from not taking money out when there was a negative year in the market and giving it a chance to rebound, but we moved over to the IUL or, cash value, because cash value does not drop when there's a negative year in the market. So you're protected against losses. So the market could go negative, but you're not going to lose money in your IUL, or you're not going to lose money in your cash value, right? So that's an important component. That's the difference maker in this strategy. So you can see, what is that? That's an 800% increase in available retirement income money. That's huge. That's huge. Just from incorporating that strategy. So just wanted to share that with you guys. If you guys have questions, drop them in the comment section below. But you want to make sure that sequence of return does not damage your retirement income. So I appreciate you guys for watching. Like, share, subscribe, drop a happy face in the comment section like always if you got any value from this, and I'll see you in the next video.